In 2021, giant trading firms posted record profit. But what is more interesting is that to produce those profits, they had to extend their borrowing facilities to unprecedented level. In this video, I'm going to explain how the largest commodity trading firm in the world are making billions on the back of their smaller counterparties only due to one reason: the 2.5 trillion trade finance gap. Commodity trade finance is an obscure part of the financial world, only fully understood by few insiders. So in this video, I'm going to explain what is trade finance, what is the 2.5 trillion trade finance gap, what broke the commodity trade finance market, how did it created massive opportunities for the largest player, and finally, an example of commodity trade finance engineering. This is an information-dense video, and I understand that not all of you are familiar with commodity trade finance. So this is why I'm going to start with the bases, and then I will end up with state-of-the-art commodity financial engineering that even people that work their entire life in the commodity trade finance haven't heard of. Let's go! Let's start with a very simple question. What trade finance mean? So let's have a look at Investopedia. Trade finance represents the financial instruments and products that are used by companies to facilitate international trade and commerce. Trade finance makes it possible and easier for importers and exporters to transact business through trade. Anyway, in short, trade finance is a term that encompasses all instruments that helps with international trade. But usually when you refer to it in a commodity angle, it's all about financing. To give an example, if a CEO of a commodity trading firm says something like, "We need to increase our trade finance capabilities," it means we need to get more funds to finance our deals. According to the Bank of International Settlement, more than 80% of today's 10 trillion worldwide trade relies on trade finance. So this number, 10 trillion, is not only for commodity trade, but for all the goods. On a yearly basis, 1.5 to 1.6 trillion of trade finance demands are rejected. So roughly 15% of the worldwide demands are rejected. The World Economic Forum estimate a drop in trade finance gap up to 2.5 trillion by 2025. Now that I'm thinking about it, how can they come up with numbers like that? It makes no sense. I mean, first, how do they get those information from the banks? Number of domains. Because if you have one cargo and you ask, I don't know, 20 banks, then it's 20 rejections. So how accurate is that? And once you get rejected like 20 times, then you just stop asking. So I even found an article on CNBC sponsored by Chatterbank that said that the trade finance gap is 3.5 trillions. So I don't know what the right number, but if you do a little bit of export-import business, you'll quickly see that the most important thing and what everyone is talking about is how to get finance. So if all the small and medium companies are struggling to get funding, then the trade finance gap must be a huge number. So between 1 trillion to 5 trillion, I don't know, but it's definitely a huge gap. So now let's see what broke the trade finance market and what led us to this situation. Basically, everything started after the 2008 crisis that brought new regulations and new balance sheet requirements for the banks. In short, it means that the banks have to put more money on the side when they lend money for a shipment. So to sum up, it hurt their profitability. In addition to this new regulation, 2011 was the time when the super cycle ended, and with a strong decrease in all commodity prices, a lot of frauds were uncovered, a lot of commodity trading firms went bust, leaving the bank with a lot of underperforming loans. Also, some banks got massive fine because their customer traded with US dollar with the US government enemies. Then, on top of that, the new ESG trend started to be in vogue. So a lot of dirty commodities such as coal, heavy fuel, palm oil became persona non grata. As a result, financial institutions starting to reduce or just stopped financing small and medium companies. Again, only the small and medium companies suffered because the cost of compliance went up for the bank, so it made sense to only keep the largest client. To put some numbers, the companies that didn't guarantee at least $250,000 in fees for the banks just got booted out. Syndicate credit lines is how massive entities are getting financed. This is when a group of banks comes together to share the risk on a borrower. Syndicate credit lines are the cheapest money you can get, and trading companies love abusing of them. Now that they are flush with cheap cash, what do they do with it? If you remember the first part of the video, I explained that the banks withdrew from the business of financing small and medium commodity players. So the largest trading firm saw it as an opportunity to make more money. They take their syndicate credit line at 2% per annum, resell it at 8% per annum, then make 6% profit. So this is roughly 0.5% per month. This is not small money. Let's say that a trader sells a cargo for 2 million with 30 days to pay. Those 30 days will add an extra 10K of profit for the trade. Not too shabby, not too shabby. And it also hooks the client to the credit. For instance, let's say that you are a cocoa processor. You buy cocoa beans, you grind them, and then you get cocoa powder and cocoa butter. Now let's say that the cocoa bean supplier comes to you and say, look, I can give you 120 days of credit. So basically you have the time to buy the cocoa bean, grind them, and then sell the cocoa powder and the cocoa butter, get your money back, and then pay for the cocoa bean. How does it sound? Good, huh? So as a factory owner, you're like, I mean, this really could help me to expand my business, so why not? And then you start like this, and of course, a few months in, another cocoa supplier will say, oh, look, how are you doing? Let me see if I can also do 120 days of credit, and then of course they can do it, blah, blah, blah. And after a few years in, your business is only working because you have those credit lines from your suppliers. And this is extremely dangerous because let's say that the market goes bad for whatever reason and that your factory goes under. Who is going to be there to buy your asset? Your supplier. So to finish, let's see how the largest commodity trading firms can create financial product out of their commodity flows. Let's say that there is a trading company that ships a vessel a week of sugar from the same exporter to the same importer. Actually, let's say that the exporter and the importer are of the same group. One company is in charge of the origination of the sugar, and another company is in charge of the distribution, and one company in the middle is in charge of trading. But all of them are 100% owned by the same group. Now, let's see how financial engineering comes into play. So backed by the commodity flow, they can create a financial product. So let's say that there is at least 60 million of value at the sea at any time during the year. So they can easily sell for 30 million of structured product backed by the sugar. So they could sell this financial product for something like 2% per annum and then take the liquidity and then make more money with it. So I hope that you liked the video and that you learned something. And please let me know in the comment below if when I speak about commodity trade finance instead of pure commodity trading, it's also of interest to you or not. And have a good day. Ciao.